Thank you, Dave, very much. Thanks, Ryan.
Yes.
Good morning, everyone, and welcome. I will call to order this quarterly meeting of the Lawrence County Retirement Board. Today is Tuesday, June 16 of 2026. A couple of housekeeping items. Ask that you please put your cell phones on vibrate or silent. I'll note that the meeting is being live streamed and also recorded. This is a 5-member board. Commissioner Sanada is out of town today, but 4 of us are here, myself, Commissioner Kennedy, Controller Prestipine, and Treasurer Rapone. This does allow for a quorum. As long as there's 3 of us here, we can conduct our business. So we have 4, so we do have a quorum. For those of you who follow us regularly, you'll notice the absence right now of Sarah Wilson from Marquette Associates. She is at a conference up in Potter County, and we're going to be calling her in just a few moments to get her report over the phone. But we always begin the meeting with the Pledge of Allegiance. We'd ask you to remain standing for a moment of silence. Mr. Rapone, as you lead us in the pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. We'll have a brief moment of silence. Thank you, everybody. We have 2 opportunities for public comment. One in just a moment, and then one before we adjourn. I'll note right now we have no members of the public in the room, but if any should happen to come in, we'll stop and give them the opportunity to make public comment. And then prior to adjournment, we'll open it back up if anybody wishes to make a public comment. Before I get to the minutes, I'll see if my fellow members have any opening statements they wish to make, and I'll start with Treasurer Rapone. Thank you. Mr. Prestipine?
Nothing.
Commissioner Kennedy? Nothing. Okay, thank you. In our packet, the agenda states we have the March 24 and June 2 minutes, but I believe in our packet we only have the June 2 minutes for us to consider.
Oh, my apologies.
I'm sorry?
My apologies.
Okay, we can always hold off on adoption of the March 24, but does everyone have the June 2 minutes? Though that, of course, was the hearing that was held with the legal counsel, but it was an advertised public meeting, so we did in fact produce minutes from that meeting. So gentlemen, I give you time to look it over, and if one of you wishes to make a motion to adopt the minutes, I'd be happy to accept that motion.
I'll make the motion to adopt the minutes.
Second. Thank you both, gentlemen. Any concerns about the minutes? If not, we'll ask Ryan to call the roll, please.
Treasurer Rapone?
Yes.
Controller Prestipine?
Yes.
Commissioner Kennedy?
Yes.
Commissioner Vogler?
Yes.
Motion carries.
Thank you. Minutes are approved. Well, that takes us to Sarah's report, and I've asked Mr. Prestipine if he'd be kind enough to see if we can reach her on the phone. As I mentioned, she's up in Potter County today, but she is expecting our phone call.
Hi, if you record your name and reason for calling, I'll see if this person is available.
Dave Prestipine for the Lawrence County Retirement Board meeting.
Thanks, Dave. Please stay on the line.
They hung up on me.
Sarah,
Good morning.
good morning. How are you?
I'm good. How are you?
Wonderful.
Sarah, I'm glad we connected. This is Dan, and you just heard from Dave, and we made note of the fact we have convened the meeting, so we are in the public meeting. We noted that you are attending a conference in Potter County. I hope it's going well for you.
It's nice, middle of nowhere, but very beautiful.
That's,
Very cold.
yes, it was chilly here this morning. But we appreciate very much your taking the time to, we know you're up there working, so we appreciate your taking the time to consult with us. I'll note that Treasurer Rapone, Controller Prestipine, myself, and Commissioner Kennedy are here. Commissioner Sanada is out of town today. And Controller Prestipine distributed the documents that you always give to us, the quarterly performance report, which is effective as of March 31. That's what this says, March 31. Is that accurate? It shouldn't be. Okay, that would be right, because we're in the middle of June. It's the first quarter. Okay. Sarah, before I turn it over to you, I'm going to see if my fellow members have any questions at the start for you. Dan, do you have anything for Sarah? No. David?
Nothing.
Richard?
Nothing.
Okay. So Sarah, we'll turn it over to you, and we look forward to hearing your report.
Great. Good morning. Nice to be talking to all of you. And let's just go through the book. Let's go to Exhibit 1, which is the first tab. And just quickly, we're going to give you a quick market update. We are currently celebrating our 40th year in business, so it's a really exciting year for us. And we've really grown. We have 145 employees. We just hired a senior consultant out of the Westchester office who's going to be working with nonprofits and endowments. One of the exciting things is you can see that we now have 27 partners. And that's really important. We're all employee owned. You know, we're the 17th largest consulting firm, but with that many owners, we have no ambition to do anything else but we're doing and be sold or merged or anything. We're standing on our own 2 feet, and we've got about 420 plus clients. So it's been a really good couple of years, and also we're to celebrate 40 years. If you go to Exhibit 2, we'll talk about the market on page 10. And I think every time we print this, we should just update it every week because so much has changed in this market and it's so day by day. But let's talk about what happened in the first quarter because then you can understand your performance. And we look at what happened with real GDP, we set an annual rate of 2%, large parts of the strong business investment and rebound in government spending. Because remember, the government was not spending in the fourth quarter. I do think that we are starting to see in the last couple of months really true economic numbers coming out, but some of those were put on hold with the government shutdown. And then let's talk about oil. This has been such a back and forth thing, but in this first quarter, we know that Strait of Hormuz was, it's shut down, and the economic impact that has been unbelievable. And we're not, they're saying it's going to open by Friday. They said they've signed this deal. It's going to take at least 2 months, as soon as that opens, for us to feel that kick, meaning that oil will go down, but then prices are going to hopefully start going down. And we look at the net hit to the oil reserve disruption as of March 30th, and the net hit to the reserves was 11.4 million barrels a day. So it really did have a negative impact on consumer spending. We also know that oil went up to its highest over 100 now. Oil last night and today, Brent cruised at 80 for the first time since March. So we have seen that come back down. And then we look at page 11, and it turns out you can see prices versus food inflation. I think what's really interesting is when we talk about food inflation, and I think that we all notice it when we go shopping, but I think the consumer is really going to start noticing it. Because remember COVID, all the prices went up, and they never really backed down. And then we have this tariffs come in full. All the prices have come up, haven't really backed down. And then it's going to be interesting to see what happens with food prices because 1/3 of the world's fertilization passed through the Strait. So that's going to have a huge economic impact on the farmers and everything else like that. So I think we have to sit back and see how long that what's going to happen there. And I don't think we'll see those numbers for another couple of months. And then let's talk about inflation. I think there's been a lot of inflation expectations. We look at what's happening with the surge in energy prices. We know inflation really stopped on. And, Kevin Morris is now in. We're going to see what happens with meeting. And at the beginning of the year, we thought that the Fed was going to cut, possibly have one or two cuts. And then that kind of went on hold when the oil happened. And then what really happened, if you turn to page 12, you can look at that on the global economy. So we go back and we talk a little bit more about the Fed, and now they're saying they thought at one point they were going to raise rates because they were seeing all this inflation. Now the Fed's come back, and most economists believe that there will not be a cut. The Fed rate will remain the same through at the end of 2027. I am not sure that's going to be the case, but that's what they're saying right now. Also, Kevin Morris, as the new chair, has said that they will not be talking as much in public, meaning that we won't get as much indication from the Fed leading the way on where they expect the economy to go and where the Fed fund rate is happening. And, one, we've seen with the Fed fund rates, even though they're fairly low, we start to see, especially in the city of Pittsburgh, they just came out with a report about all the foreclosures. Foreclosures are starting to come up, and that's because of all the credit, the refinancing, and everything else. So the housing market could become a little bit softer with the Fed not doing anything on rates. We look at the global economy, and China has actually been able to get through this global economy fairly well. They're been a little bit more resilient. We look at what's happening in Europe. The European Central Bank, the Bank of England, are expected to do multiple rate hikes. So this is going to have an effect, especially when we look at small mid-cap managers within the emerging market and international space, which you have some exposure to. We look at page 13, we talk about what happened in the first quarter, and we can see that most of every asset class was in negative, except obviously commodities were up 24.4%. I think that's interesting. Gold hit over 5,000, back down to around 4,000, but silver actually really went back up and almost hit 100, and now it's eased back down. And that means when you see a lot of changes in commodities, not only oil, but you see it in like gold and silver, you then tend to have a very volatile market. And we certainly had a very volatile market in the first quarter. We know it hit all highs and then it hit a lot of lows there. And we look at developed non-U.S. equities were down. U.S. bonds were flat for trailing 12 months for 4.3. We know that despite the dollar strength during the quarter, U.S. equities underperformed non-U.S. and emerging markets. So you can look at that. And then global listed infrastructure, which you now have exposure to, is very, very well within this market because it's an inflation. People go to that as an inflation hedge. Are there any questions so far?
Apparently not, so we'll ask for you to continue.
Okay, let's go to page 14. And we look at what happened in the first quarter, and you can see consumer discretionary was actually down 9.2% for the quarter. You can see information technology was actually down 8.7%. And we know that those Magnificent Seven are still driving this market. We also know from a stock perspective, value stocks outperform growth stocks, which is very important for you because we know you've done well and they actually protect you in the down market. We know that small caps have really had a volatile market last year. The top 25 small cap managers in the United States were off their benchmark by over 16%. So they just not had a small cap year. We look at page 15 and we look at some of the things that are going on, and I think this is an interesting graph. We look at what has happened with S&P 500 index prices returns in the presidential cycle. So you see year one, the average is 6.6, and then year two, we're in year two at 3.3. Then look at year three, it really takes some momentum off, and then it backs down in year four during the election years, which we're waiting to see what's going to happen, what administration come in and how does that look on policy. When we look at what economists are saying for this year, they're saying that the S&P 500 is set possibly to do about 5% this year, which is moderate growth. That it might take 8,000, it's at 7,000 now. So that's going to be interesting when we look at what's going to happen with the market. There's some good news in the market, and I think this is really good. When you look at the bottom graph, look at how much earnings per share estimates have grown. In March 2023, they were at 200. Now they're at 311.54. So we do expect good news out there from a lot of the companies that are reporting. They have, unemployment is low right now. The workforce borrowing is much cheaper than it was 2 years ago with interest rates going down. And one thing that we have noticed is that a lot of corporations had a lot of cash on the bank, on their book, and then they started to reinvest. We also know with AI coming out, data centers and everything else, the market is really transitioning, and we're seeing a lot of good news from there. Are there any questions on the market? All right, we'll turn to exhibit 3, and let's see how you did. So at the end of March, you were at 115.2 million. I can tell you at the end of April, you're at 121 million. We're looking at, you had a net negative return of 1.1 with a net investment loss of 1.3, but the market did a negative 4.6. And this is where this portfolio is doing exactly what it's designed to do. It's protecting you in the down market. With a trailing 12 months, March to March, you returned 13.6 with a net investment gain of 13.9. But since inception, since we've been here and you've kind of done this discretionary, you've had an annualized return of 7.9% with a net investment gain of $79 million. Positive attribution was your non-U.S. equity composite did very well, infrastructure, defensive equity, and then just negative, meaning global equity manager Dodge and Cox, had a little bit of an issue, but we are not concerned with them at all. Your low investment fees of 27 basis points. And then looking ahead, we have Eaton Vance, and we'll talk a little bit. So Eaton Vance is a small cap manager. We've had them in portfolios for a very, very long time. As I mentioned, small cap managers really struggled last year. So we kind of sat back and looked at them. We look at these portfolios every week. And then we put them on watch. Then in about 2 months ago, we got a phone call at the end of March, beginning of April, when we were doing our update weekly with them, that their key portfolio manager left, so we fired them. And the reason why you fire somebody so quickly is when performance is down and you start seeing the team lead, something's not working. So we fired them, we put them into an index, and then we put them into, we put that portion into MFS. So we acted very, very quickly. Yes, it would have been nice to get out of them last year, but when you looked at what everybody else was doing, there was nothing out of the ordinary. Are there any questions on that? All right, let's turn to page 32, and we'll just see how your manager did. So page 32, your total equity composite was only down 2.1 versus the market of 2.9. And then you can see Eaton Vance obviously was the drag. But since they have been in there, they've annualized 9.8 versus 9.2. You can understand that as a long term, they have done very well. They just had a bad 15 months, and then we got rid of them. Page 33, you can see WCIM that we put in last year did very well in protecting you. That's under the global equity composite. It's very well protecting you. They were only down 5.6 with the market down 7.7. And so we put them in, they've been like 13.2 versus 12. very, very good local manager. And since we put them in, they've annualized 8.8 versus 8.5. MFS low volatility was positive when the market was negative, and you can see that trailing 12 months 13.2 versus 3.9. Non-U.S. equities will go down to the bottom of DFA, or another new manager we put in April 2024, and you can see they were positive in the down market, 3% versus -2, and for the trailing 12 months, they've done 31.2 versus 29.2. If you turn the page to page 34, you can see real estate was positive. There is at 1.1, median realty was 0.7. And, we don't expect real estate since inception some 4% versus 3.9%. But real estate's there to give you a really good dividend. It protects you in a down market, kind of well diversify you. And it's really that dividend. And as you know, you pay out money every month out of this retirement fund. If you look at infrastructure is 2.6 versus 2.1. They were positive. Trailing year, they've been 11.1 versus 6.4. And since we put them in, average 10.6 versus 6.6. Infrastructure, inflation hedge, has great dividend, pays it out, and it really, really does very well in a volatile market. Defensive equity, you can see is -0.3 versus -1.7, trailing 12 months 14.4 versus 10.8, annualized 8.5 versus 7.1. When we look at these three asset classes, and this is what you've done very well with the board, you diversify, you put these in, and they have really protected you from really going down with the rest of the market. And also, we expect them to do between 4 and 7%. And that's what they've consistently done if you look at your inception date from there. U.S. fixed income, it was for the quarter was flat. For the 12 months, 4.5%. But then look at since inception, 1.9%. That is one of the reasons why we took fixed income down to 22% of the portfolio, and we added in all those other asset classes plus global. And you see C.S. McKinney right there, we transitioned from them. They're your active manager. And since inception, they've done 2.9 versus 2.4. Core plus borrowed funds is down off a little bit for the trailing 12 months. It did 4.64 versus 4.3. So I think you're very well positioned in this market. There are no asset allocation changes right now we would want to make. I think that, with the size you are, it makes sense to have, the real estate infrastructure, defense equity. It does not make sense to have any exposure to private equity or private credit. I think your size, you could do it. I would not suggest doing it. So we always kind of review the asset allocation every so months, and then once a year I go and we do an asset allocation study on the portfolio, and I think we're in a really good position. We're expecting the markets up, down, every day it changes. I really believe this market's a 3-week medium-driven market for now. They kind of have to hold back and wait till everything kind of settles out. And I think we'll start seeing hopefully some positive changes as the oil situation gets sorted out. But we're not going to see that till the end of the summer, which will be really hard on travel. And we look at a lot of, industry sectors that, really depend on summer travel. We also look at what's happening flying anywhere is so outrageous because of the gas prices. And we'll have to see how farmers fare with all the costs there. But I think you're in good shape. Do you have any questions?
Well, Sarah, I'll start, and as always, we appreciate how thorough you are and helpful this information is. What I'm taking away, I'm going to refer back to page 22, and the fact that the official report you're giving us, of course, was the first quarter of the year, ending on March 31, and as you note in the document, the we did have an investment loss of 1.1%. However, and I wrote it down, at the end of March, the fund stood at $115.2 million. And you're noting that at the end of April, which was only about 2 weeks ago, the fund stood at $121 million. So that to me, that's the takeaway. Even though that's maybe not quite as official as the end of the first quarter, but it's certainly 121 is a lot better than 115. So I don't have any questions, but I'm going to turn it first to Mr. Prestipine to see if he has questions.
I do not.
Thank you. Mr. Kennedy.
No, I don't need
Okay, thank you. And then Mr. Rapone. Well, Sarah, it sounds like you've answered everybody's, if they had any questions, sounds like you answered all of them. So Sarah, do you have, and I know we want to let you go because you've got important business up where you are. Do you have anything else for us today?
I don't. I will, if I'm assuming I have to do the controller conference,
Yes, you will.
and then I will be, it's at the, teacup, and then we are scheduled, and I'm double checking this meeting.
Try August 11.
August 11th is on there.
That's what I showed. Do you?
I hope everybody has a great summer. Of course, I always appreciate you and clients. You're a very wonderful county to work with, and I will see all of you soon. And if anybody has any questions in the meantime, I'm always available.
Sarah, we can't
Thank you, Sarah.
can't thank you enough, and be safe in your travels.
I will. Thank you. Bye-bye.
Bye-bye now. Gentlemen, thanks for your cooperation in this format. It worked well. I thought it worked very well. New business. Do any of the board members have any new business they'd like to bring up today?
No.
Okay, we have no resolutions on the table. That takes us to public comment. We, again, have no members of the public in our meeting at this time. But before we adjourn, I do want to see if my colleagues have any final remarks they wish to make, and I'll start with Treasurer Rapone.
I just wanted to ask David as far as fund.
And we just got our report a month ago, 2 months ago, we're at 99% funded.
Would that report have come in before the end of April, the 121 million that she?
It's as of the end of last year, though.
Oh, okay.
It's as of December 31st of 25.
25. So at that point, we're at 99.
Yes.
What would your estimate be right now?
Probably around the same.
Okay, that's good. And as we've said many times, that's better than a lot of counties. Am I right?
Yes.
Rich, anything
Yeah,
else?
thank you.
Thank you. Mr. Kennedy?
Nothing.
Thank you, sir. Mr. Prestipine?
No.
All righty. Well, as we noted, this board will convene once again on Tuesday, August 11, right after the conclusion of the commissioners' meeting. It starts at 10 o'clock. So we'll probably start around 11:45 or so on August 11. Ryan, anything on your end?
No, sir.
Okay, thank you. Well, gentlemen, thank you all so much for taking the time to be here today. If there are no other matters of business to be discussed, could I please have a motion to adjourn?
I'll make a motion to adjourn.
So,
It's been moved and seconded. All those in favor, please say aye. Aye. Opposed, same sign. Motion carries. Meeting's adjourned. Thank you, everybody. David, thank you.
Next resolution.